Welcome to TalkTickers. You're here for our focused breakdown of SEO Energy's latest earnings call.
That's right.
Our job today, well, it's pretty simple. Boil down the key info, cut through the noise, so you get a clear picture of what really matters. Let's get right to it.
Okay, so SEO Energy's recent call, it really painted a picture of strong operations, especially, in their upstream business.
Upstream, okay.
We saw a really impressive output from the oil sands. Christina Lake in particular stood out.
And downstream.
Also strong, at least in Canada. Their refining operations there hit record levels of activity.
Okay, sounds like a bit of a tale of two segments then. Upstream firing on all cylinders, but maybe some issues downstream. What caused that split?
That's pretty much it. Yeah. Upstream saw its operating margin climb nicely.
But downstream?
Downstream faced some, let's call them headwinds. This was mostly down to planned refinery maintenance turnarounds, which always bump up costs temporarily.
Right, the turnarounds.
And also tighter price differences for heavy oil. We also saw softer refining margins, the crack spreads, in the Chicago market specifically.
So those downstream challenges sound more like, well, short-term things. Market conditions, planned work, not really fundamental problems.
That seems to be the case, yeah. Despite all that, SEO Energy still generated significant operating cash flow.
Okay.
And their free cash flow for the quarter, a solid $1 billion.
$1 billion. And clearly they're putting that cash to work. Looks like shareholders are front and center.
Absolutely. They announced an 11% boost to the annual base dividend. That signals real confidence in future earnings.
Yeah, an 11% hike isn't small.
No, it's not. And on top of that, they kept buying back their own shares, both during and after the quarter.
Suggesting they think the stock might be a good value right now?
Exactly. It points to a belief that the company might be undervalued.
Okay, so big picture here. Despite some downstream pressure points, the overall vibe seems positive. Momentum plus a clear focus on returning cash to investors.
That sums it up well.
All right, let's dive deeper then. That upstream production, you said the oil sands numbers were strong.
Definitely attention grabbing.
Yeah.
Total upstream production hit 819,000 barrels of oil equivalent per day. That's substantial.
And Christina Lake led the charge.
It did. Reach an impressive 238,000 barrels per day. And crucially, it continues to be a leader in efficiency.
Efficiency measured by?
The steam oil ratio. It maintains a low ratio, which is critical in oil sands.
Right. Less steam per barrel means better efficiency, lower costs.
Precisely. It's a key metric.
And scaling that kind of efficiency is definitely notable. You mentioned Narrows Lake, too. That's coming online soon.
Yes, the Narrows Lake project. It's basically a tieback to Christina Lake. Construction's complete.
Okay.
And they expect first oil early in Q3, so quite soon.
What's special about Narrows?
Well, the steam line connecting it is, get this, 17 kilometers long.
17, wow.
Yeah, it's the longest in the oil sands industry. It lets them access some really high-quality reservoir, cheaper than developing it standalone. And they expect a good performance, low steam oil ratios again, and potentially high peak well rates, maybe over 3,000 barrels a day per well.
Sounds like a really strategic move, boosting production and efficiency. What about their other big oil sands sites? Foster Creek.
Foster Creek also had a strong quarter, pulled in 203,000 barrels per day.
Okay.
That benefited from new well pads coming online and, just optimizing their programs.
Any work happening there?
Yes, they're actually in the middle of a planned turnaround right now. They're adding new steam generators.
Investing for more capacity.
Exactly. The aim is to boost Foster Creek's production by another 30,000 barrels per day. That should come online by early 2026.
So some short-term downtime now for a pretty decent future gain. Makes sense.
It's the standard playbook.
What about the Sunrise asset?
Sunrise averaged about 52,000 barrels per day. They finished the first phase of their growth plan there.
Okay.
And similar story, turnarounds are planned now to get ready for the next phase. That's in the Eastern Development Area.
And the goal there is the same, efficiency and more production.
You got it. Lower steam oil ratios, higher production. They're targeting early 2026 for that ramp up too.
So a really consistent theme across the oil sands, efficiency drives, strategic expansions.
That's the focus.
What's happening offshore? In the Atlantic.
Volumes there were up. That was driven by higher rates from Terra Nova and also the White Rose field coming back online.
Good news there. And the big project, West White Rose.
Making good progress. The huge gravity-based structure, the GBS, it's nearly ready for deployment out to the field.
And first oil timeline.
Still anticipated for Q2 2026. So that's a major one to watch.
Definitely. A lot of pieces moving towards completion over the next, year and a half?
Yeah, quite a bit underway.
Okay, let's switch back to downstream again. You mentioned record throughput in Canadian refining.
Yes, absolutely. Record quarterly throughput. They ran their Canadian refineries at an impressive 104% utilization.
104%. How's that possible?
It reflects operating above nameplate capacity, often possible after debottlenecking or upgrades. It really shows the benefit of past investments they made, especially in their upgrader facilities.
So those earlier investments are paying off now in operational terms. What about the U.S. refining side? How did that compare?
The U.S. business is building momentum. Throughput is strong, costs are coming down, reliability is improving.
That's positive.
Yeah, their Toledo refinery is going through a major turnaround right now.
Yeah.
That's expected to drive more performance improvements later this year, second half.
Okay.
And the turnarounds at their other U.S. refineries, the ones they don't operate themselves, those are finished now.
Right. So it feels like these turnarounds, while they hit the current quarter's results, they're really setting the stage for better performance across the board in refining later on.
That's the plan. Yeah, laying the groundwork.
Okay, let's dig into the financials a bit more. The upstream operating margin increase that stood out.
It did. Saw a healthy jump. That was really a combo of the strong production volumes we talked about.
Right.
And higher sales prices. Plus, the narrowing heavy oil differentials helped too.
That's the price gap between Canadian heavy and benchmarks like WTI.
Exactly. With more pipeline capacity coming online, think TMX, the Trans Mountain expansion, those bottlenecks ease up, and the discount on Canadian heavy shrinks. That benefits the upstream producers.
Got it. And conversely, those same tighter differentials put pressure on the downstream margin, along with other factors.
Precisely. Tighter differentials hurt the refining side. Add in those lower Chicago crack spreads, some inventory value adjustments, and of course the turnaround expenses we mentioned.
Right.
And that explains the pressure on downstream margins. But it's interesting, Canadian refining still managed to increase its operating margin.
Even with a lower upgrading differential.
Even with that, yeah. Which really highlights their operational efficiency up there.
That's pretty resilient. And the U.S. refining financials, are they trending up too?
Yes. They showed better adjusted market capture, improved refining margins, and importantly, they're getting a handle on controllable operating costs, bringing those down. That's a good sign for future profitability.
Makes sense. What about capital spending in the balance sheet? Debt levels?
Capital investment for the quarter was $1.2 billion.
Focused on?
Mainly sustaining the existing base business, plus funding those growth projects, oil sands, Atlantic, normal stuff.
And debt.
Net debt ended the quarter at $5.1 billion. That number moved around due to a few things like redeeming some preferred shares and working capital swings.
But the message was?
Commitment to balance sheet strength remains a priority. Management emphasized that.
And that strong balance sheet underpins the shareholder returns story. That 11% dividend hike and the buybacks are pretty clear signals.
For sure. They even noted the dividend increase is supported even if WTI oil prices drop to $45 a barrel.
Wow. Okay. That shows confidence.
Serious confidence in future cash generation. Yeah. And the share buybacks just continue, showing flexibility and, again, that view that the shares might be cheap. And they hinted that as these big growth projects wrap up, there could be scope for even more shareholder returns down the line.
Interesting. Looking ahead then, what are the key milestones or guidance points they highlighted?
Well, first, they expect most of the planned turnaround work for 2025 to be done by the end of Q2. So smoother sailing operationally in the second half.
Good.
Narrows Lake, as we said, is on track for that Q3 startup.
Okay.
And West White Rose keeps marching toward that Q2 2026 first oil target. Overall, management's guiding for strong operations in the back half of 25 and into 26.
And spending levels, how might those evolve?
They see capital spending coming down in 2026.
As the big projects wind down.
Exactly, especially West White Rose. They floated a preliminary number for 2026 CapEx in the low $4 billion range.
Low fours, that's a noticeable drop.
It is. And that suggests potentially more free cash flow available for other things.
Like more shareholder returns, potentially.
That would be the implication, yes.
Were there any other kind of strategic points or longer-term goals mentioned?
Yeah, a few things. Management really hammered home the focus on just running the base business flawlessly.
Operational excellence.
Right. And building on that downstream momentum we talked about. Delivering the growth project successfully and keeping a tight grip on costs.
Standard stuff, but important.
Very. Longer term, they mentioned looking at integrating their Lima and Toledo refineries better, find more efficiencies, boost margins there.
Makes sense. Any new development areas?
They see potential in areas like Kirby West, which is near Christina Lake, and they want to push Sunrise production higher, maybe towards 75,000 barrels a day, by developing that eastern area with its better rock quality, targeting lower steam oil ratios.
Still focused on the core assets then?
Primarily, yes. They like their conventional business, but the focus is clearly on oil sands, offshore growth, and refining performance.
Anything on the policy front? Pathway Alliance?
Discussions there with the governments are kind of on hold post-election, they said. But it remains a priority for long-term competitiveness, dealing with emissions.
Okay. And they address some workforce changes?
Briefly, they framed recent adjustments as a private matter, linked to the investment cycle winding down and preparing for lower capital spending ahead, about ensuring competitiveness.
Got it. So, boiling it all down for listeners, what are the key takeaways from this call?
Okay, number one, strong underlying performance in the upstream, particularly oil sands, and upcoming projects like Narrows Lake have real potential.
Right.
Two, Canadian refining's record throughput shows past investments are working.
Sigh.
Three, downstream results were hit short-term by turnarounds, but expect improvement, especially in the U.S., later this year as that work completes.
Okay, maintenance impact fading.
Four, big commitment to shareholders. That 11% dividend hike and ongoing buybacks signal strong confidence in future cash flow.
Very clear message there.
Five, capital spending looks set to decrease in 2026, which could free up more cash, potentially for more returns.
Watch that space.
And finally, keep an eye on progress for those major growth projects. West White Rose, Foster Creek expansion, they're key for future production and profit growth. Watch the turnaround completions and the Narrows Lake ramp up too.
Excellent summary. All right, it is time for our This Is Not Financial Advice segment. Let's put on the speculative hats. Based on this call, what's an outrageous but plausible trade idea you're seeing?
Okay. So we've got SEO Energy making steady progress on West White Rose, targeting Q2 2026 first oil.
Big offshore project.
Huge. And at the same time, they're buying back stock pretty aggressively, suggesting they think it's undervalued.
Right.
So here's a thought. How about going long SEO Energy stock, maybe pairing it with a Q4 2026 call option, strike price maybe, say, 35% above where it's trading now?
Q4 26 calls, 35% out of the money. That's reaching a bit. That's the outrageous part.
That's the outrageous part, yeah. It's a long time frame, significant price target, banking on a complex offshore project coming online smoothly, which always carries risk. Delays happen.
Sure. So what makes it plausible?
The plausibility comes from their strong operational track record elsewhere, like the oil sands performance.
Okay.
Plus, they have a clear timeline for West White Rose, and management seems laser-focused on shareholder value, as shown by the buybacks and dividend.
So it's a bet on execution of a major catalyst over the next year and a half, essentially.
Exactly. Higher risk, yes, but potentially higher reward if that catalyst delivers as planned.
Interesting idea. Okay, so wrapping up our deep dive into SEO Energy's call, what we see is a company, well, delivering strongly in its core upstream areas, investing strategically for growth, like with Narrows and West White Rose, and really prioritizing shareholder returns through dividends and buybacks.
That's the essence of it. The oil sands progress, the Canadian refining strength, the advancing major projects, it all points to continued potential.
And management's actions really back up their confidence in the business outlook.
Definitely.
So, as always, we hope these insights give you a great starting point for your own research and analysis. Think about what stood out most to you from this discussion.
Yeah, definitely do your own homework.
This has been TalkTickers, bringing you the essential takeaways from the latest earnings calls. And just a reminder, that trade idea we discussed, purely informational for entertainment, definitely not financial advice.
Please remember that.